Welcome back to Two Graybeards. Nick and I are going to talk to you about what happened this week and then how it affects our thinking going forward. So, this week really happened all at the last 5 hours of the trading week with a long awaited employment number being essentially a non event. And then soon after, at 10 o'clock, the manufacturing and services surveys that are forward looking for how the economy is doing, called the ISMs, were very weak. The market broadly, stocks, bonds, commodities, well, not commodities, stocks, bonds, gold, all rallied, and the US dollar fell. Why do you think that happened, Nick?
Well, as you said, it's a forward-looking number as opposed to a backward-looking number like non-farm payroll. What we had this week is the market getting bearish all week ahead of what they expected to be a very bad employment report, i.e. a high number, and that is essentially what we got. But because everyone was already short, the market couldn't really react to the downside. Even the short end didn't react much more than a couple of basis points. And as soon as the ISM came out, as you said, we flew. 2-year tenures, 20 basis points, 3-year tenure, 25 basis points. Just a lot of buying. People are very, very scared that this is the beginning of the recession, although we are very, very close to it, and the ISM is signaling the start of it very, very soon.
And what you mean by that on the 10-year and 2-year, 2-year, 10-year, is that the 2-year didn't move much, a little bit, but the 10-year rallied a lot, with longer term bond yields falling quite a lot. Now, just briefly, overall, since our last recording, the S&P is up 1.5%. Again, almost all of more than all of that this afternoon. And gold is up about 3%. Tips are basically unchanged, though they're up a little bit. Commodities are down a little bit, but what really flew, as you said, was the long-term bonds, the TLT, which were up 3.5% for the week, which is a fairly big rally.
Well, close to 5 actually at the close, and that is, funnily enough, the only thing we didn't manage to buy because I left limit orders at the close of last year, and everything else apart from TLT and EWW, which is the Mexico ETF, didn't get filled. And of course, as Sod's Law would have it, those are the two things that went up most. I felt like buying them all week, but then I thought, no, our rules are that we don't do anything unless we discuss it in the video first. And I thought that it just wasn't worthwhile doing. So we will discuss it now, what the allocation should be for next week, and change the orders, and I'll put those orders in live so everybody can see them.
Yes, please. We'll hit that at the end. One basic question, which is, our portfolio looks like prior to this conversation, we started with a heavy cash allocation because cash is earning 4.5%, and a balanced allocation across bonds, equities, commodities, etc. But underinvested in terms of cash. In those two dimensions, should we put more cash to work? I wouldn't chase equities. The news was without a doubt bad for equities because growth slowed significantly, and yet equities rallied quite a bit today. So to me, I wouldn't want to put cash into equities. Bonds, that's a different question. What do you think about equities, at least?
Right. Well, I would agree with you. What happened is that everybody got short, as I said earlier, and then they got squeezed, and they will keep on getting squeezed probably Monday, Tuesday, and probably until the CPI number. The I agree that equities should not be rallying anywhere near as much as bonds on these news, simply because the odds of a recession are changing. I would have thought that the odds of a recession on the horizon have increased rather than decreased. What happened today is the fact that the long end of the bonds rallied so much, it basically blew out all the short positions in the high beta stock in the Nasdaq and stuff like that, and basically pumped up the multiplier slightly. So what we are not seeing yet is the effect on the E in PE, but I think we will see that quite soon. And as you said, for the week, equities were up 1.5%, but TLT was up close to 5. And I think that that trend will continue. And we are very likely to be soon in a situation where risk off means risk off, i.e., it means that bonds go up and equities go down. We're not there yet, but I think the odds for equities are getting worse, and I wouldn't mind reducing them at a level. And the odds for bonds are getting better, and especially for the 3 to 7 year part of the curve, I would say.
Right. The data was weak. And so it's hard to extrapolate data that it's one number, and it's a survey number, and that can change rapidly. But that is what the Fed is trying to engineer through its rate hikes, and it is sensible that they are succeeding. They've done a lot. The most levered way for a cash long only investor to take advantage of that is in that 3 to 7 year space, because if we do have a deep recession, the long end of the curve will rally, no doubt about it. But currently that's part of the curve offers higher yield than the long end of the curve, and so that's a attractive way if rates really collapse. So yeah, I'd agree. So given the weakening data and assuming we can extrapolate that to further weakening, I'm less certain than you are that we can, to be honest, but I do believe that a good portfolio should be adding in that sector, taking some of its cash, which is yielding 4.5% as it is, and not give up much in yield, but potentially get some capital appreciation with low risk. So I agree. The 3 to 7 year space looks attractive. There's a ETF called IEF that is around that in duration.
Absolutely. IEF is about 6, 7 years at the moment. We could do, shy to IEF, but I would have thought that IEF would do. We allocated, in bonds, we bought 50% of our 15% allocation, so 7.5% in TIP. We didn't buy any TLT, but we will do this week.
Right.
Monday or
We're gonna make
Tuesday.
up. We're gonna just pay up to get the
We'll,
TLT
we'll
in.
just pay up and look big. And then what I would suggest is that since we've got quite a bit of cash, we've got $75,000 just in cash in the sweep, or whoever put it in the Vanguard Federated Money Market Fund, it's the same thing. And I will explain that later in the video when I go through the broker statements. I suggest we take 50,000 of that and put it into IEF. As you say, we are not giving up much yield, but we're getting a lot of duration, and therefore we're playing the odds.
Right. And what I'm very reticent to buy I think have to get allocated. So I'm supportive of buying the long end of the curve that we, had a limit. It didn't get filled, but now it makes more sense to own at current prices. I'm a little reticent on equities, and I do like the idea of, who knows where equities go. I do like the idea of having a plan to lighten up if equities really do rally, because it doesn't make sense to me that the data, if you extrapolate it, is supportive for equity earnings. And so, I'd be looking to find a way out of some of our equity exposure, even though we have so much cash on the sidelines, into a further rally.
I certainly think that if we get anywhere near the 4100 to 4125 area in SPX, it's a great sell. I would sell everything that we have in terms of SPY at those levels, and at the end of the video, I'll put in an order at that level to sell the exposure that we have.
Great. And when I look at our portfolio, if that were to occur, if equities were to rally, what's that, about 5%, 200 points, we would then be long mostly bonds in an environment in which equities don't offer great value and the economic climate seems to be worsening for equities. So I like that tactically. I don't think that it doesn't feel to me that a wholesale deploying of cash that we've kept for admittedly only a week, but we're thinking as investors, a wholesale deploying of cash into risky assets and bonds makes sense at this stage.
I would agree completely. I would much rather be long of bonds than equities. Much safer. We are still in almost uncharted waters, and it looks like the economy might be in trouble. Therefore, I completely agree with you, and that's what I'll do in the portfolio.
Great. Sounds good. Sounds like a plan. What about next week? What do we look for next week? I see $98 billion worth of 3s, 10s, and 30-year auctions, which need to be absorbed by the market, which could put some downward pressure, but, we're very strong right now.
Absolutely. I would be surprised if we get more than a 10 basis point back up, and I'll be using that period to buy some TLT and buy the IEF, as I'll indicate in the video where I examine the account.
Right. And then I guess the other big news will be the CPI, which is on Thursday. Somebody asked me whether the number is going to be cool, meaning low inflation. And the answer is the expectations are for there to be zero inflation in the month of December. So it can be negative. We're going to, it's an interesting time where we're going to actually see in this highly inflationary period a potential negative inflation print.
And what people forget is that we start getting negative inflation prints. What that means is that margins are going to get compressed.
Right.
And margin compression will actually be bad for equities. And that is why I think that we could very soon have a situation in which risk off is truly risk off.
Yeah. I'd add to that is, unfortunately, the wage inflation, which is an input cost, is staying high, where the actual CPI, which is the top line sales, essentially, could potentially go negative from an inflation standpoint. So besides the fact that inflation's zero, which is bad for margins, a portion of inflation, which is the input cost, remains high. So there's a lot of risk in equities, worth keeping an eye on.
I would agree. Let's keep with bonds and add to bonds and have a sell level in equities and get out when we can.
Sounds great.
And here you can see the positions in the account. These are all the ETFs we bought. Underneath are the orders, and you'll see them in the next video as well in detail. And you can see the performance. Just one quick word. We started with slightly over 250,000, and that will be reflected in the broker statement that will be uploaded. The only things that we didn't buy were, of course, the things that went up most, and I've changed the buy orders for TLT and for EWW, which is the Mexico ETF. Those we didn't manage to buy at the limit price. and that is the way trading works. But everything else we managed to buy at the limit price. Here in SPY you have the limit sell that we've put in as well, as discussed in the video. So you have everything here. This ETF IEER, it's only $188, and this will hopefully disappear from this account next week. But it really makes no difference because you will have the broker statements and everything will be in it, and we will backdate it to $250,000 by moving certain amounts, the roughly $7,000 that the account was overfunded with very shortly, and then we will have a completely clean account with only $250,000 on the start date in January, and going forward the performance will be absolutely clear. All the allocations and all the exact percentages will be in the broker statement. And here you have the orders for next week. I've input the sell orders we discussed in the video. Near 4100, it's 409.9. I'm going to be buying 500 units of IEF for a total of approximately $50,000. I will buy the TLT best I can on Monday. I put in a limit order of 105, but I will finesse it over the course of Monday or Tuesday. And EWW also, that market is very strong and I don't want to miss it. I will be taking it up to market on Monday. All these orders will be screenshotted and inputted into the links with this video, together with the broker statement, so you can see exactly where we started from, what we did, what price we paid, and what the performance is to the penny.
So thanks, Nick, for going through the portfolio. That'll be a regular feature. Next week, we'll see you around the same time with the developments of the week. Thanks very much for listening.
Pleasure talking to you, Andy, and let's hope we have a very profitable week next week. Thank you very much for listening.
Good day.